Well, welcome everybody. We were waiting for people to get on, so welcome and good afternoon. We're glad to have you on this month's office hours. I'm Amy Akamuti, an associate advisor here at Flagstone Financial Management, joined by lead wealth advisor Dan Staus. If you're unfamiliar with Flagstone, we are a fee-only comprehensive financial planning firm. One of our top values is education, and we seek to continually be a resource for solid financial information outside of our regular meetings with clients. Our hope is to make people's financial lives meaningful, and we see ourselves as a partner in helping you achieve your goals. Today, Dan will talk about 401k investing, and we'll take any financial questions you have. As always, if you have questions after our webinar, feel free to reach out to any of us. You are automatically muted with no video, so no one can see or hear you. To submit a question anytime during the discussion, click the Q&A button on your Zoom controls and type in your question. You should see an option for it to go to everyone or just the panelists. Please choose panelists only. Finally, Flagstone is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. With that, let's get started, Dan.
Cool. Thanks, Amy. As Amy said, I'm Dan Staus, lead wealth advisor here at Flagstone, and we're doing these office hours maybe once a month or so. The first half is going to be kind of us talking about a topic, and today's topic is 401ks. What things do you need to know about your 401k? And we're not going to answer those questions. We're going to say, here are the questions that you need to be asking your 401k provider or yourself. And this doesn't just apply to 401ks, it applies to a lot of employer-sponsored plans like 403B or 457B. And this is from the employee's perspective. So if you're a business owner and you've got a plan that you provide to your employees, there's a whole other set of questions that you need to be asking yourself. So that's kind of the angle we're going to take today. And then, so we'll take questions throughout, and we'll answer those throughout as well. So Amy, feel free to interrupt me if people are asking follow-up questions for any of the stuff I say. And then we'll have the second half, purely dedicated to Q&A. So, all right, number one thing to keep in mind with a 401k, and this is a super basic one, and you've probably heard it a million times from other people, so I'm just going to get it out of the way. Know what your company's offering in terms of a match, and 9 times out of 10, it's going to make sense to take advantage of that match. So companies might offer 100% match on up to 3% of your salary. That means they'll match whatever you put in, 100% of what you put in, up to 3% of your salary. Or it might be 50% of what you put in, up to 8% of your salary. Or there might just be a straight up contribution that's going into your account from the employer, no matter how much you're contributing. So that's not really a match. That's just a contribution that they're making on your behalf. So know what the rules are and try to make sure you're taking advantage of that unless there's really good reasons for you not to be doing that. Second concept that I wanted to mention with 401ks is, and this is another one for people who are in the contribution phase of life, they're still working for that employer. Know if there's a Roth option. So there's Roth versus traditional, or another word for traditional is pre-tax, but those have different tax treatments. And some 401k providers allow you to make Roth 401k contributions, others don't. It's more common. I think it's more common than not now. It wasn't the case like 10 years ago, but more common than not to offer that Roth option. So I'm not going to get in detail on the tax treatment, but I did write a blog article a year or two ago about Roth versus traditional that can gets in depth about that. Maybe Amy could put that in the chat. And when we publish the video, we can put that in the description of the video, a link to that. But, Roth generally makes sense when you think your tax rates are going to be higher later in life. That might be for a 30-year-old who, has a lot of earning potential, but isn't necessarily earning a lot yet. It could also be a 65-year-old who who's going to work for another 3-4 years. They're making contributions, and maybe they've saved a ton, and they're going to have these huge RMDs when they're 72 that are going to push them into a higher tax bracket. Well, then maybe it makes sense to contribute to Roth. But there's a ton of other factors to consider. You just want to know if that's an option in your own plan. Investment options. What can you invest in within your 401k? I mean, there's things as flexible as just allowing you to invest in whatever you want, basically. I mean, some 401ks just give you access to a brokerage account. You can buy or sell whatever you want. There are others that just have like very limited options. So you want to make sure that you know how each of those investment options are, like what areas of the market they're exposed to. You might have one option that's just U.S. large cap stocks. You might have another one that's just international emerging markets. You might have another one that's like a global stock fund. But we believe it's really important to broadly diversify, and you want to know and get some level of diversification in your 401k. How exactly you do that completely depends on risk tolerance, need for return, and again, what's available to you. But that's kind of number one thing to think about with those options is like, what am I actually investing in? Number two, what are the fees associated with each of those investment options? So some funds are super expensive, some funds are super cheap. Some funds, beyond the fee discussion, some are active, some are passive. We generally favor lower cost options that historically the lower the cost, the more likely a fund is to outperform. Which is counterintuitive. You'd think that the more expensive ones would be more likely to outperform because maybe you're paying an all-star manager, but that's really not the case, historically speaking, at least. So know what they cost. And lastly, don't base your allocation decisions on past performance. Like, don't make that the big reason you pick something or don't. There's some people who say, you should look at historical returns on these funds and look at 10-year performance. And if it's 10 years or better, then that's a good one to invest in. That's like total garbage. That's a terrible way to put a portfolio together. You need to consider and know what the performance is, but that shouldn't be the primary reason you invest in something. Because as Amy said in our compliance disclosure, past performance is not indicative of future performance. And so that's true. It's not just the disclosure, it's the truth. We want to base allocation decisions on, diversification, cost, and expectations for future returns, and then correlation to other assets. It's not, don't use past performance, which is kind of disappointing that so many providers, it's like, here are your options, and here's the areas of the market they're in, and here's what their past performance is. Like, it's 50% of the information they give you about the fund is all about performance. And it's just, it shouldn't be prominent. I mean, it should be there, and they shouldn't hide it. But anyway, sorry, I get passionate about that.
Dan,
before I go on to things here, Amy, I don't know if there's any follow-up questions that people have had, or should I just keep going?
There are. You had mentioned cost of a fund, and there's a question that asks, how much can a mutual fund cost for you to think it's expensive versus low cost?
Okay, yeah, what's an expensive fund versus a cheap fund or a low-cost fund? The expenses can range from, I mean, there's even zero cost funds now. I don't really see those in 401ks, but they can, typically it's between 0.1% or 0.05% to like 1.5% would be a pretty expensive fund. It's all relative. So an emerging markets fund, for example, a cheap emerging markets fund might be 30 basis points or 0.30% is what that means. Whereas a cheap US fund might be 0.1%. I mean, some areas of the market, they're just more expensive to invest in. The operations needs to be more in depth and more sophisticated operations to do that. So that just costs more. But, if you're seeing a lot of funds that are like 0.9 or above, or yeah, I'd say that's a kind of maybe a good rule of thumb. That's pretty expensive. The average cost of the funds we use at Flagstone for our clients in like a 60-40 stock bond mix is like 0.27%. And we think that's pretty low cost. You can get lower for sure, but hopefully that answers the question.
Thanks.
Okay. Services. What are you getting from your 401k provider? So we'll talk about fees on the account in a second, but what do those fees get you? Are you getting investment education from the provider? Are you getting investment advice from the provider? Those are two different things. Like today's webinar is all about education, and we're not giving advice. And with our clients, we actually give advice. So is your 401k provider doing that or not? Usually they don't give advice. Usually they're restricted to just giving education. But sometimes you can pay extra and get advice from your 401k provider. Are they rebalancing the portfolio? If they're not, sometimes there's automated tools within your 401k platform that can do that. That's kind of it's not super common yet. I think it's gaining popularity, but you can set your portfolio to automatically rebalance, let's say once a year or twice a year, or there's different options there. But is that available to you? Are they doing it for you? Are they helping with more like cash flow and transfer type administrative responsibilities? I mean, are they helping you with required minimum distributions? Are they helping with tax withholding decisions? Are they helping with qualified charitable distributions? Is that even a thing you can do with 401k with 401k provider? I've even seen people whose 401k providers, and I'm talking about like more either retirees or people who have left their employer right now. But I've seen people who are retired and they want to take out like $10,000 from their 401k. It's unrelated to a required minimum distribution. They just need $10,000. And their provider's like, well, you can take out the entire amount or you can leave it be completely regular. You can't just take out chunks here and there. And that's an example of a 401k provider who doesn't really want to help people beyond their employment. Sometimes they do want to help, sometimes they don't. And so that's kind of like a minimal service example. And other times you can, have that 401k till you die, and they help you do all the stuff you need to do between now and that time. So services range quite a bit. Are you getting financial planning? That's pretty rare with a 401k provider. But I mentioned that because the next section here is fees. And a lot of stuff you hear when you're thinking about 401k versus IRA, for example, is like how much does your 401k cost versus how much does your IRA cost? And that's totally an important question, but it's only a small piece of the puzzle. So here's an example that I like to think about. Let's say you're going to the Chevy dealership and you're going to buy a car, and you see a the new Chevy Blazer, which is like a compact SUV, and you see the Chevy Suburban, which is like this enormous SUV. And you look at the costs; they're not the same. They're completely different. I haven't looked at the MSRP on this lately, but your Trailblazer or your Blazer might be half the cost. Well, that's not the only thing that differentiates those two vehicles. Like there's the ongoing maintenance cost, that's one thing, but then the benefits, like you have way more space in the Suburban, you have more towing capacity, you have more cargo room, more room for the kids or the pets or whatever. And then there's some downsides to it too, terrible gas mileage, etc. So cost is one part of the decision. You need to consider what are you getting from the 401k provider as well. So
I do have a question, Dan.
Yeah, go ahead.
A viewer asks, how do I move an old 401k account to my IRA?
How do you move it? It depends on the provider. Usually you fill out a form with the 401k provider on what you want to do with it. And there's an option to do partial withdrawal, full withdrawal, transfer it to an IRA, those types of things. But that sometimes it's online, sometimes you print out the form, sometimes they mail you the form, sometimes you do it over the phone, but you usually initiate it with your employer. And then the last thing do you think that does a good job of answering that, Amy? Because I have one more thing on fees.
I do, and I have a couple other questions too, so.
Okay, just so I don't forget, regarding fees, like we talked about investment account option fees, that's the fees associated with the specific option in the account. But we didn't really talk about the account level fees. There might be an administrative fee that's $100 a year, $50 a year, or $5 a year. There might also be a fee that's a certain percentage of the account value. So you just want to know what all-encompassing fees are when you're considering costs. So,
all right.
I had to say it, I was going to forget. So, what other questions do we have, Amy?
Good information. Let's see. If my employer doesn't offer a match, should I still contribute to it?
That's a good question. Oftentimes it still makes sense, yeah, but you want to, it's kind of a financial planning question. It's a derivative of the question, like how much should I be saving for retirement? And that's really specific to a person's scenario. So oftentimes it does make sense. Other times you can just contribute to an IRA, but the limits are way less, like $6,000 a year or $6,500 versus in a 401k for people under 50, they can contribute $19,500. So significantly different. So that's, so anyway, some people contribute to IRA to accomplish their retirement goals. Other people, maybe they're self-employed and they contribute to a SEP or a simple. That's kind of unrelated because we're talking about 401ks here, but and then other people are over limits to deduct IRA contributions or to even be able to put money in a Roth IRA. So oftentimes, like if you have aggressive savings goals, you still would want to use that account, but other times you may not need to.
Great, thank you.
Mm-hmm.
Another viewer asks, I'm 68 and about to retire. Should I still own any stock?
That's another really, the answer is really specific to the client's situation or to the investor situation. I don't know. I do know that most of the time it makes sense to still have some stock exposure because stocks offer pretty good inflation protection. If you had all your money sitting in cash and inflation was 2% in the long term, then that money is losing 2% purchasing power every year, so if it's not earning anything. But there's a lot of variables in that discussion. So I don't really know, but like the art of portfolio management is you kind of combine, the big picture, you combine stocks with bonds and to create a portfolio that has the appropriate level of risk. So if you got decent bond exposure, if you've got like a 50-50 stock bond account, then the risk on that account compared to 100% stock account is completely different. And so you can usually manage risk that way. And usually doesn't make sense to just completely drop all your stock exposure when you're retired. But sometimes that might be necessary or not jeopardize your financial plan. So I can't say that with definitivity.
All right. Well, I want to remind everybody that you have the ability to ask questions. So please do if you have other financial questions. Dan, did you want to say anything else about 401ks or a retirement savings?
I don't think so. I mean, we help people with 401k stuff when they're clients. So I should mention that. And like if someone's an investor with us and they have this 401k on the side and they're still working at that place, then we can help them with investment selection and all these things we're talking about today. But if someone is a client and they don't work there anymore and they choose to kind of do that on their own, and they choose not to have Flagstone manage it, then that's going to kind of be up to them. So yeah, I think that's probably the extent of what I had on those topics.
Great. Thanks so much. That's great information.
Cool.
I do have another question that's very relevant to the week. And
okay.
The question is, what's up with GameStop?
What's up with GameStop? That's a good question. It's been in the headlines lately. It's super technical. If you Google short squeeze, you can kind of see a definition of what that means or what happened. And that's what happened with GameStop. Basically, a bunch of hedge funds had shorted the stock, and then a bunch of individual retail investors who got their information from Reddit forum all started buying the stock, and so the price started going up. And when that happens, if you've shorted the stock, then you're going to lose money. And so they had to buy positions to kind of hedge their bets. Anyway, there's a lot of transactions that go into that to describe how it happened, but it's crazy. The stock took off like, I don't know, hundreds of percents in a few days, and then earlier this week it tanked again. So it's like a lot of people made money, a lot of people lost money. And when it was doing really well, when the price was up a lot, it was the retail investors, like the average Joes who were like making a ton of money on this, and the big hedge fund managers who were just taking a bath. And it was kind of a cool, like, little guy, David versus Goliath type thing. But then, if those individual investors held on to that stock, they've now lost a ton of money compared to what the stock was, because it dropped so much in value. So yeah, it's like a big market timing thing. It's a day trading thing. It's totally against what our investment philosophy is. Mike, the founder of Flagstone, he had an interview with Channel 8, a local news station here in Lincoln, Nebraska. And so I think it's still published on their website. So maybe we can throw the link in the chat for that. And then on the published video, we can put it in the video description. So yeah, check that out. It's like a 3-minute description of what I took more time just now talking about it than that story, but I think you probably articulated it better than I could. So.
All right. Well, I'm putting that in the chat right now so people can check it out. No more questions on my end, Dan, and I'll let you wrap up, but I do want to say thanks to everybody for joining us.
Yeah, Yeah, thanks everybody. And we'll potentially have another one next month. But always, email us in between if you have any other questions. But glad to have the opportunity to do a little education and field some questions.